Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to break it up into our normal three segments of, the brief overview of the EIA numbers, a deep dive into U.S. refined products, and then in the third one, going abroad and looking at what's happening in the global market. So when we start talking about, before we get into it, we want to look at what is happening based on the hurricanes that have come through. So we had Henri, then we had Ida, then we had Nicholas, which came through. So we still have some residual from Ida hitting both production as well as the refining side. So the assumption was that I had put out there that we would have almost, most of this back, maybe about 10% still missing. 5 to 10% was the number I had used. But right at this point, we still have about 600,000 barrels a day that is offline. We peaked at about 1.7. So a little bit closer to 1.8. So that still leaves a significant amount that has not come back. So we still have that 600,000 barrels a day or so that will start to come back. But Shell is the one that's struggling right now to bring some of these platforms. So that's where we're going to see some of the longer decline. And then on the other side, we do have about 800,000 barrels a day still offline on the Louisiana side. Then when we look at what happened with Nicholas, which came through Houston, it really didn't impact much when you're looking at the production side. When you look at refining, most refiners were reporting no issue. One did end up having to shut down because of a loss of feedstock. That looks to be temporary. The biggest component with Nicholas is going to be how quickly does some of the Houston Ship Channel adjust, some of these other regions that had to shut down or limited outbound traffic, only allowed inbound or vice versa. So you're going to get still some of that residual that's going to come through on top of what we have missing from Hurricane Ida. So one of the things that we wanted to just look at, and we're flipping it around a bit just to cover kind of some of the differences that we've seen. One of the things when we look at run rates, it's, here the makeup was on the PADDIII, where you can see PADDIII refinery run rates were up 281,000 barrels a day, really bringing us to that pre-COVID level. So it's still a very, very strong side. But net, utilization rates were only up 0.2. So we went from 81.9% to 82.1%. And we should still get back to about 87%, just given where things are and where things sit on PADDIII. So when you look at where things are down, where PADDIII went actually down further from where it was, down another 259,000 barrels, that's something where there was some residual that had come through that will reverse. So we will get a tick up in PADDIII as this week progresses, and then we start preparing. Because remember, next week's number is going to be for this week's data. So it's just going to be a matter of when do the imports come, when does some of this adjustment. So we will see PADDIII pick back up and really start to see some of that recovery on the other side. One of the things that we always talk about is, hurricanes aren't new to this region. So one of the things that we always discuss is where is crude production? And when you look at Harvey, you look at Nate, you look at Barry, Laura, the Arctic blast, Ida, one of the things that we've seen so far, and obviously the drop from COVID, who can forget? But one of the things with production, you can typically see how quickly there is that snapback. And what makes Ida a bit different was the hit to Port Fortune in terms of trying to adjust the supply chain, because you had to move from different slips, different regions. Now that that's in place, we're expecting this to again accelerate. We're not going to get right back to where we were because of the issues Shell is having right now. But at the same time, we have those two offsetting when you look at Shell Norco and then you look at PSX Alliance. So there is a certain amount of offset when we're considering one versus the other, but it's still something to consider to see how quickly we get that snapback. So one of the things that we wanted to keep looking at, because why not? Because there's cyclones. When you look at what is coming through, it's good. When you look at the impacts from the Chanthu, the typhoon that's coming through, went through Taiwan as a level 3, hit some of the, essentially just missed some of, going on land in China, but did cause some issues when you're looking at the port side. As we were saying, you have to limit some of the different capacity that can happen, and then it's shifting over and will make landfall in Japan. So one of the things that we're also going to talk about for a minute here is when you're looking at what's happening. China has announced that they're going to release, again, those 37 to 73 million barrels, depending on timing of where things are. The first tranche is going to be 7 million barrels. So right now they're looking to do this from November to February, depending on where things sit, and they're going to allow private mega refiners with import quotas to participate. So we are starting to see some movement, some means, as we've been talking about in China, trying to address the issues when you're looking at where the overhangs are and where the overhangs typically reside when you're looking at some of these adjustments overall in terms of pricing and where they're trying to, again, manage that internal cost. So at the same time, China is facing another outbreak of COVID. They are stressing people to not move around and travel for the September holidays. There's a bigger backdrop when we're looking at some of the problems going forward. And then when we look at China's crude oil inventories, it's because everyone makes such a big deal about OECD and where some of the differences are and how we've had some of these drops in the U.S., but when you look at pre-COVID and post-COVID looking in China, you get an idea of how non-OECD countries are sitting on a significant amount of crude still. That is one of the things that is hard to gauge, hard to get a real read on. But this is where we're sitting here at about 870 million barrels or so, or 879 million barrels. When you're looking at where we were pre-COVID, and again, there's a lot of seasonality with it, but when you look at where we were about 770 million barrels. So we're still about 100 million barrels that's residing in China, which again, how much of that is in SPR or is, we can call semi-SPR versus commercial, that is going to get moved back out. So when we look at the outbreak at this point, it is the Delta variant, but the reason, and I apologize because I know many people are tired of talking about COVID, the reason why this one is going to be a little different, it started in more of a rural section, so they don't have the same type of testing, same types of issues. So there's a concern that the outbreak is going to be a bit broader this time, which is why, again, they're trying to accelerate people not moving about. And if you remember last week, we were talking about how China was already seeing a big increase in refined product exports, which again is pushing more into the market and shifting some of the dynamics in general, which again is pushing more product into storage within Asia, which is then kicking things over into the U.S. Not into the U.S. and into some of these other regions when you look at Europe or the Atlantic Basin in general in terms of where some of this additional capacity is coming into that market. So when we look at crude oil away from the SPR, you can see we're right back to 2019 levels. We're back down to a new low for 2021, which again is pulling some of this additional capacity out. We had the gift of EIA in terms of pushing some of that production down, allowing more to come from the inventories in general. But now we've also seen some of the reaction to this, which is some additional purchases from Nigerian grades. We have Iraq, and we'll talk about this in segment 3. Iraq has actually cut OSPs into the U.S., and we'll talk about what that means and how we're going to see some of this additional Middle Eastern crude coming into our markets, which again is just addressing some of these shortfalls. And again, it's looking at heavy versus light, because a lot of what has been lost is Mars and some of the heavier blends, which again need to be replaced in order for PADDIII to operate efficiently. So then when we look at days to cover, you have to factor that this is looking at both sides when you're talking about days to cover on oil storage, but it's also looking at refined run rates. So here you have run rates that have come down and storage has not come down in parity with that. So that's where you're getting some of this elevated numbers coming through and actually getting an increase where when you look at crude storage, you have this drop closer to 2019. But then when you look at days to cover, you can see days to cover for 2019 was much lower, closer to about 21 days. So you can see that the delta, and it's coming from the refining side. And one of the reason why we talk about this is because with the ramp up in refining comes new imports, because that's where they marry with each other. Is because at this point, PADDIII is the one that still has not come back to, or is still well below that pre-COVID level. So because of that, if they were to run back to where they go back to their typical run rates, we can't be importing at 5.7 million barrels a day. It would have to be something much higher. So like right now, imports were at 5.76 million, which is 1.3 million or 1.34 million off of the 5-year average, and 1 million of that is driven by PADDIII. So if we were to start to see the run rates go up, we'd also have to see imports come up because of the way PADDIII is configured to be much heavier and requiring something closer to 32 to 34 API gravity, and not what the U.S. is producing of anywhere from 40 to 48, especially when you're considering the Permian. So then when we put all of this together and we look at it, not only just of crude, but also looking at gasoline, distillate, jet fuel, and resid. Here you can see we're just below 2018, so you had a nice little drop. This is where, when we look at what is coming through, we had a little bit of a drop in imports of products, which again is a positive because it's going to pull some more out of storage. Based on where run rates are, I'm actually surprised that there wasn't a bigger drop. So my view, and this was before Friday. So when we did the show on Wednesday, my view was that you were going to get a makeup in imports, you were going to get a bigger, a small build in crude, and then you were going to get a big draw in products. Instead, we got a big draw in crude, and we got actually a much smaller draw from products than what I was expecting. So there's a certain amount of makeup with that, but it's still a net bullish number, but we want to look at where is the backdrop for the next 4 weeks, because we do have that noise that continues with Hurricane Ida and then with Hurricane Nicholas. And the reason why with Nicholas, again, it's just the ship movements in terms of was there more leaving than going in, and we'll talk about that more at the beginning of segment 3. So when we look at gasoline storage, we're still moving in a seasonal normal level in terms of that drop. Obviously, it was a much bigger drop. When you look at 2017, which was Harvey, you can see that we're actually mirroring it almost perfectly when you're considering some of these impacts. One of obviously the difference between Harvey and this, Harvey had a much bigger impact to refiners because of where it hit versus where it is right now. But when you look at the drop in demand, that's where you're getting some of that offset between the two. And then when you look at European gas arrivals in the U.S., declined to the lowest in 3 weeks. When you look at closing off at September 9th, but that will start to offset on the other side. And it's just, again, and as we said last week, we're not going to get this huge surge. We're just going to get a very steady number going forward of about 340 to 300 to 375,000 barrels a day. Total gasoline arrivals in the U.S. from Europe declined to 304,000. Compares with the revised 380,000 in the previous week. So again, I would say that that's probably the peak and trough when you're looking at where some of these flows are coming from. And the reason why is because the arbitrage is open, bringing barrels from Europe into the U.S., which will incentivize additional cargoes to come into our markets. Then when you look at distillate, you can see that we're sitting here in a lot of noise, but just looking at 2021, we're right back to these lows of 2021, just above the lows from this period for this year. Now, we're going to start to see some of this reversal, but when you're looking at production, so when we look at gasoline production was down another 51 basis points to about 66%, but disti was down another 38 basis points to about 29, just below 29%. So when you're looking at some of the percentages, again, we're expecting to see some of this shift because as we talk about, And we discussed weather, and we've talked about propane and LPG and the potential for gates to get thrown up. We've talked about LNG and natural gas, but there's also heating oil. What are we going to do about heating oil at this point? Because based on the way the new rules and regulations are, especially in the Northeast, you can only run ultra low sulfur diesel as heating oil. So you have a lot of competition when you're looking at trucking, when you're looking at rail, especially trucking, when we consider where we sit on the supply chain and the utilizations that we've seen on the trucking side. So then when we take that to the step forward to jet fuel, that's where jet fuel continues to weaken a bit. We had a build in jet fuel, still in a lot of noise, and they're going to try to manage this because as we see it going forward, there's going to be more benefit to producing and selling distillate versus jet fuel. So we should see this stay fairly mixed, let's just say within a typical normal level. And they're going to put some of that excess and kerosene into the disti pool to help bridge some of that gap. And that's where, again, you're going to see our exports remain under pressure, as a lot of that is going to stay internal, and you're going to see a lot of that get absorbed. So then when we're looking at the curve here, you can see the curve is obviously shifted to the right with the different shifts. Now we're out to essentially August of 2022 above 65, above 60 as we go through pretty much the end of 2023. So a lot of opportunity, a lot of movement when you look at the production side. Again, as we've said, that we're not going to get this huge surge in production, but there's just a lot of staying power when we're considering where we sit right now and where the curve is, which is going to keep some of these barrels moving. And then when we consider what is going to happen going into the October meeting for November, when we're considering OPEC and what are some of the setups, this puts them in a good position to essentially just keep things moving as they have laid out already, of just that normal progression of increases going through November. So then when we look at COVID, just to provide some of that update, the U.S. continues to sit at a fairly stable level. The U.K., same thing. When we look at India, there's been some drop. When you look at Asia Pacific in general, you're seeing a very steady move. Japan, Malaysia starting to come to the other side, Thailand, Vietnam. South Korea remains a bit sticky when we look at some of these different shifts. But for the most part, as we've been saying, there's been some movement or mobility moving back to some of those norms prior to some of this increase as things start to normalize. But it's still at a muted percentage as we're seeing some of these backdrops kind of adjust in terms of some of shifts on refined product. So then when we look at crude stock draws, here you have the 6.42 million barrels coming out of storage. You can see it was driven by PADDIII and PADDIII. So PADDIII had a drop of 3.2 million, PADDIII had a drop of 3.85, and PADDIII had a small build of 970,000. So when you're looking across the 5-year average, you're getting the meat of it from PADDIII and PADDIII. So PADDIII is down 13.4 million versus the 5-year. PADDIII is down 17, where PADDIII is right in line. PADDIII is actually 1.5 above, and PADDII is down 5. So then when you look at Cushing, and as we were saying last week, we expected Cushing to have that draw. We thought that there was a little bit too much to the other side. So we were saying that we had to really look at the 4-week average, especially based on hurricanes. We thought some of the what was left in Cushing was due to, again, not being pulled down to the coast. So there was going to be some of that makeup, which is right here. So we do expect to see some of this reverse a bit as we go in. But again, a very gradual number. This isn't going to be a big reversal of a 2 million build. It's going to be, 700,000 barrels build on the other side. And that's why it's like looking at that average. And then PADDIII is going to be a matter of where is Houston Ship Channel, where is the Calcasieu Pass, where is the loop. So we know that the loop was fully operational by September 9th. But when you think about when this is reported, September 9th was Thursday of last week. So you still had those issues where you missed imports for an extended period of time. And then so this week is really where we're going to see some of this adjustment as the loop catches up. Some of these guys continue to pick back up. And as we start to see additional cargoes coming from the international market into our market, the SPR, so the commercial stocks was at 6.42. When we include the SPR, we are at 6.95 because remember there was a small swap that came out of the market from SPR into the market. So here we recognized about 500,000 barrels, 530,000 barrels coming from the SPR into the market. And then when you look at what has happened so far for production, this is only reflecting an increase of 100,000 barrels. So this is, again, as we were saying, this was showing a drop of 1.5. We peaked at about 1.75. And then we were right now down to about 600. So you can see here, when you're thinking about where we sit, there's about 1 million barrels that is missing from this number, which again is going to get made up this week. So that's where you're going to get also some of that adjustment as some of that flows back into specifically PADDIII as the U.S. continues to purchase euros. But that has also leveled off a bit as we've seen euros drop from a discount of $1.05 to negative $2.35. So we went from $1.05 to $2.35 on a downward momentum in euros within 6 days. Just to give you an idea of that push, you had Libya issues which have started to flare up again, but we're gonna in one specific region, which again is gonna not put a bid back into euros, but just keep it from going back to where it originated, which was $2.65, $2.75 discount. Instead, it's going to provide that base to keep us right at that $2.35, $2.30. So then when we look at land storage, so here you can see that there was another build in the East Suez. So when you look east of Suez, we're now back above the 5-year average, after coming a little bit closer. And when you look at just typical seasonality, there's normally that drawdown as we get into essentially the middle of October. And one of the things that we've been talking about as we look at east of Suez, we expect it to just go again sideways. So the comps are going to get a bit easier when you look at that sideways move. And then when we look at west of Suez, Europe had a build last week. They had a build again this week. U.S. obviously had a draw last week, had a draw this week. So Europe is going to soften some of that. But when you look at the movements in general on west of Suez, we're just going to continue to move down and then start to move sideways as we get some of these makeup numbers within the U.S. And then when we put it all together and we look at that tracking, the east of Suez is going to offset some of these drops that we saw in west. So that's going to keep us, again, moving sideways and bring us closer to that 5-year average just based on where things are going. Again, this is going 2015 to 2019, which is the numbers after the OPEC breakdown, which again puts us at a different level here. But one of the important things that we keep talking about is the global storage on the floating side, because a lot of people like to just look at what's happening onshore, but let's look offshore, where we continue to see a lot of elevated numbers in the east of Suez. That's going to remain. There's additional cargoes coming into China at the moment. We'll talk about that in the third segment. So you're going to get some of this replacement where west of Suez is essentially going sideways, right in line with 2020. There's going to be a little bit movement upwards when we look at what's happening in Europe, North Sea, and then what's happening with Nigeria. So net, when we look at floating totals, again, it's just going to be a sideways move and still remain elevated when you look at it versus historics. So then when we look to road fuels, so China was at about 96%, and you're starting to see it roll over again. That rollover is going to accelerate as they have that COVID outbreak. And it's less about the COVID outbreak, even though that is a problem based on their zero tolerance when you're considering their, but it's really what are they doing with Macau? And for those that are looking at casinos in terms of going after the casinos there, incentivizing or saying travel as little as possible in the month of September. That, or at least in the remainder of September, that's going to put some of those headwinds. And then when you look at Europe, Europe is following something similar that we saw in 2020, coming back to that peak. And then there was an outbreak, but when you look at some of this, we're not going to get back to normal, but we're going to be able to hold at that 90%, 95% for Europe. Rest of Asia is continuing to come back, as we talked about with the COVID update, while the Americas has weakened a bit. And there's a mixture of what's happening in Latin America, what's happening in the U.S. There's a lot of headwinds when we consider what is going to normalize going forward. The U.S. is just seasonal slowdowns. That's going to continue, and we'll talk about that more in segment 2. So then when we look at PADDIII, when we're considering the storage levels, here you can see we're still above 2019. When you look at what happened in Harvey, yes, it crushed the refineries, but it really didn't do all that much to the production side. People still went away, left to ensure safety, but then they're starting to they came back much faster, and it didn't impact, again, the port that was supplying about 90% of them. So that's where we have some of this disconnect. PADDIII is at the lowest levels for 2021, which is a positive. We will get some reversal, but again, we're just, if anything, it's going to go back to these 2017 levels, but not overnight. It's just when you look at 2017, you had some of that normalization as we got into the typical period where you have draws that will typically go through, as we get to about the beginning of October, and then you start to see some of those builds. But again, this is something that I would say PADDIII goes more sideways with a trend slightly up over the next 4 weeks, coming in above where we were in 2019, but right where let's call it about 275 million in terms of what is sitting in storage at this point. And then when you look at Cushing, this is what we were saying, where we had that big makeup number, and now we're moving right with that 15-year average, and it's gonna again go back up, just not at the same massive increase as we've seen. Then when we look at imports were down 48,000 barrels a day. That's 1.34 million off the 5-year average. PADDII was up slightly by 47,000. PADDII had that drop down. We were saying that we expected to see that drop, just given, again, timing. So there was a drop of 327,000 barrels a day. We got a little bit of that residual that we expected last week. And it was just, if you couldn't get to the loop, are you able to get into the Houston Ship Channel? Again, loop is the Louisiana offshore oil platform, which is 20 miles offshore. So when you think about VLCCs, it's not like you can just, park that right in Houston. So there's some Suezmax that can do lightering, that can go in the region. And then you did have the loop come on at the beginning of September 9th. So you did get some of that movement. It's just, this is where we think there's going to be a little bit of that increase. The question is going to be, how much does Nicholas impact that? Because when you look at it, they were stopping outbound, but inbound, but were allowing outbound. So how much of that outbound was exports, and how much of that, stopping inbound, stopping imports? And now everything is back to normal, with full normalcy is promised by Monday. So far, there doesn't seem to be much residual. So we should see that a bit sooner. The question is going to be how much is made up and how much slips into the following week. And then when we look at PADDIII, as we were saying, we saw some of that residual in offshore waiting to come onshore. So that was an increase of 130,000 barrels a day. We think PADDIII stays fairly stable based on what is waiting to come in by constant at that 1.295 million. So then when we look at implied demand, we finally had the makeup number in gasoline. Gasoline dropped 716,000 barrels a day, went from 9.6 to 8.89. We were saying that there was a chance it could go 9.6, 9.1, 8.7, and then back up. Or it could be all at once. Here, we essentially all of this was all at once, and we think that there's a bounce now to about 9.1, 9.2 at the high end, but again, right around that level as we go through the, as we are now firmly in the beginning of the shoulder season with kids back in school. But now the question is going to be how much is lost with work from home, people not commuting as much, flex schedule, and again, that's where we think some of that residual will remain. We got a little bit of a bounce in disti. I was expecting a little bit more. It was only up 110,000 barrels a day. Again, still very strong, still up above the 5-year average. Trucking is supportive of that. Jet was down 246,000 barrels a day. As we were saying, we were going to get another kind of makeup because we only came down to 1.6 when we were expecting to come down about 1.4. So as we said last week, it was just going to be in 2 weeks and over the course of 2 weeks instead of one. And here's that makeup. We'll get a little bit, not so much an increase, but there's enough now to really hold us at this 1.4, 1.35 level going forward. And then propane remains fairly strong with an increase of 27,000 barrels a day. So those are some of the backdrops. One of the things that we want to say for the hurricane, and we'll go through it more in segment 2, we did have Colonial Pipeline 1 and 2 go down because of Nicholas. Line 1 came back pretty quickly. It could be measured in hours, where line 2 was down for about 24 hours. So again, there's a lot of slack in that line, and where it takes 4.3 days or so to get to the from one end to the other. So it's not like there's not too much of an issue. It's just going to be a little bit of a sluggish move, but that'll be made up over the coming few days. Floating storage creeping back up. Again, you had IDA. Floating storage is things that haven't moved in 7 days. So you still had the residual of IDA. Then you had Nicholas coming through. So you had ships that had to move. Again, these are things that we see this going back up and staying in the bottom of that cloud. It's just a matter of when do the ships show up that have been purchased from abroad, and when do they sit idle enough to be counted. PADDIII, we were expecting a spike back up to about 1.5 million when you look at the essentially the top, or right near the top of the previous high at the beginning, middle of August. Instead, we still have this residual staying fairly low. So again, we believe there's going to be that makeup number as we go through the next 2 weeks. And then PADDIII, as we were saying, we expected it to come back down to the 5-year average, came just below. We just think it stays, again, just above that 5-year average going forward. And then when we look at refinery utilization rate, we just wanted to, again, do a deeper dive here, because the white line is Harvey. So you can see just where we sit right now. We expected to have a bit of a spike close to what we've seen with Harvey, where we're going to get, again, that spike up. We've already seen a lot of that happen over the last few weeks, the last few days. Those two residual, it's just a matter of starting up, going through your process, and coming to the other side. So we will see some of this recovery in this residual, getting us back to this 87% utilization rate. So that's all we have for you on the total. In the next segment, we're going to go much deeper into refined products and what do we see for demand going forward as we go further through the shoulder season.